Hi, Masters Advanced Accounting. We are about to go over a large problem, so strap yourself in. I believe this is going to take me a while, so I'm going to try to make it the video as quickly as I can to keep your attention, but I can't promise you that it won't be at least 20 minutes. All right, so, but we'll see. All right, so here's the problem I'm about to go over. It says Hebert Incorporated acquired all of Ramby's company's outstanding stock on January 1st, 2020 for $574,000 cash. So they paid $574,000 cash. Okay, who bought who? Hebert is the parent and Ramby's is the sub. Okay, this is how I know it's this transaction. Give me a minute. Annual excess amortization of $12,000 results from this transaction. I'm going to go back to that in a minute. On the date of the takeover, all right, so it's a takeover. Now I'm reading down. It says, assume that Hebert's internal net income figures do not include any income from the subsidiary. Okay. Does this problem say that the other company is being disposed of or the other company is going away? No. So this is a consolidation transaction. This transaction will have a parent and a sub. So you are going to have to do consolidation entries. All right, so next thing that I want to explain to you. Annual excess amortization of $12,000 results from this transaction. Okay, what could happen? So what happened was, if it's amortization, it could have been a patent. So the subsidiary, the patent, that the book value on the books, they ended up having a larger fair market value. You would take the difference between the two and say that the difference is maybe $50,000. Well, that difference you have to amortize. So you would separately amortize that $50,000. Most often it is the straight line method. And so what this company has to do, the parent company, is they have to amortize that $50,000 over how many years that will last. Okay, so we'll go back to that in a minute. All right, on the date of the takeover, Hebert reported retained earnings of $400,000 and Rambers reported a $200,000 balance. Then it gives you net income for each parent and sub. It gives you dividends. So what I like to do and get in this habit is I take notes to myself. So here's where I started. Here's the parent. I have the beginning retained earnings balance. I have their net income for 2020, net income for 2021. I have the dividends and the dividends for both years. Then I separate. I have the sub. I have their beginning retained earnings. I have the net income for the sub for 2020. Net income for Rambos for 2021. I have the dividends for 2020, 2021, and I include the amortization. The amortization will affect the subsidiary's net income. Okay, so the amortization will affect the subsidiary's net income. I just take notes before I start looking at what they want in the problem. All right, here's the first question. Assume that Hebert's internal net income figures do not include any income from the subsidiary. All right, great. So this figure does not include any of the subsidiary's net income. That's important to know. If the parent uses the equity method, okay, so this parent has three choices that they can do to figure out their consolidation. Now, this is at the lower level. Here are the three that they can choose from. So go back to that PowerPoint slide I posted in Blackboard and make sure you take good notes on that. there is the equity method, there is the partial equity method, and there is the initial value method. I will go through each of those for this question. However, for the first question it says, if the parent uses the equity method, what is the amount reported as consolidated retained earnings on December 31st, 2021? That question is very important. Please underline the word consolidated. You need to understand that your answer will include consolidated information. And when it does, you will eliminate some of the lower level entries. So, for example, dividends from the sub will get eliminated in the higher level consolidation. Okay? The only thing left will be what affects the retained earnings. So, what would affect the retained earnings? All the subs, revenue and expense accounts. Those are going to get consolidated and those will stay. All right, so we're going to do A first. I'm going to do that right here. Okay? What I'm about to figure out is the consolidated retained earnings with the equity method first. All right, before I begin, this is the Holy Grail. This is the method that if they complete, that you will see they won't have to make any adjustments at the end. All right, but I'll get to that when we get to the question for C. All right, so the consolidated retained earnings will only be the parent's portion. Okay, so will only be the parent's portion. Don't forget, we don't include any equity accounts of the subsidiary. All right, so I go over here. Oh, I'm going to try to write small, everybody. All right, so I have my beginning retained earnings for the parent only. That is $400,000. Okay, I'm going to check that off. Next, I will include the parent's net income for Hebert for 2020. I'm going to kind of break them out. I'm going to do 2020 first. So I check that off. Next, I will include the Hebert's dividends for 2020. I'm going to show that separate. 10,000. Don't forget, show that in parentheses. Remember, dividends subtract from retained earnings. Okay, now I am going to look at 2020. I've got all 2020 for the parent. Now I look at 2020 for the sub. Don't include this, right? Because I don't include the sub's equity accounts. However, this will get consolidated to the parent. So I am going to include net income Ramby's, and that is 20,000, and I'll show that as a positive. I check that off. All right, I'm looking 2020 first. All right, watch. No dividends in the consolidation. Those will get eliminated. All right, so no dividends. However, I do want to include the amortization for 2020. All right, let me make this clear. And then amortization, because remember, it's going to be the same amount every period, 2021, and that would be 12,000. So I do want to include that amortization for 2020, 12,000. Okay? All right. Now, I'm going to go, this was all 2020. Now I'm going to start on 2021. So I have net income for Hebert 2,000, I'll just draw a line, that will make my life easier. 50,000. Let me check that I found a home. Then I have dividends. And that was 10,000 for 2021. Let me check that off. Next, I'm going to have net income for Ramby's. I hope I'm going to fit it, everybody. Net income Ramby's, and that is 30,000. Okay, remember, don't include the dividends in this. I'll tell you why in a minute. It's because it's consolidated information. You will eliminate those. Amortization, I will include. And that is 12,000. However, let me show that, show that in negative. Show this as negative. Dividends are negative, amortization. Add it all the way down, all right? Add your positives, subtract your negatives, and then you will get 496,000. What is that number? That is the consolidated retained earnings at the end of, so 12/31 2021. Okay, so that's the end. That's why it includes both years. This is 2021. Okay? All right, so no matter which method you choose, guess what? It will be exactly the same because this is the consolidated information. So your answer for the next questions, all right, so here's what it says. 14, if the company uses the equity method, what is the amount reported at 12/31/2021? 496,000. Would the amount of consolidated retained earnings change if the parent had applied either the initial value or the partial equity method? No, it would be exactly the same. Why is it exactly the same? Because this is asking for consolidated information. So rightfully so, when I'm in class, students say, well, how do I know that it's consolidated or it's not? If it doesn't say consolidated, then you will assume it's not consolidated. Okay, so this is asking for consolidated information. It doesn't matter which method you use, you'll have the exact same number. However, B will be different. Here's B. Under each of the following situations, what is the investment in Ramby's account balance on Hebert's books on January 1st, 2021? Remember, the investment account is an asset. All right, so let me go back here. Our original debit and credit, when we first purchased this company, no matter which method you choose, the corporation would debit the investment in sub or Ramby's, $574,000, and they would credit cash $574,000. So no matter which method you choose, your beginning balance will always be $574,000. However, this question just is asking for the investment account. This is before you consolidate. This is the lower level. No entries at this time have been eliminated. When I say the word eliminated, that means that the entry has been wiped back out. All right, so it's wiped to zero. So none of that has happened. Here's the first. The parent uses the equity method. All right, so if the parent uses the equity method, let's go over here. So let me do B right here. Trying to be neat, everybody. And I showed you the base. Look at my PowerPoint on how you compute base. I like to do a T account, all right? So I like to do a T account investment in Rambus. This is the equity. Remember, this is an asset account. A debit will add, a credit will subtract. Okay? Well, let me bring down my first entry. I will begin with 574,000. Okay? All right, now it says that the income for 2020, oh, let me point this out to you too. All right, so let's go back to 14. It's asking for what is the balance in the investment account on January 1st, 2021. So it's not asking at the end of 2021. You will only include 1 year for that. Everybody, please pay attention to the dates. I feel your pain. I do it as well if I don't look at the date. It's only asking for January 1st, 2021. So you haven't, January 1st, 2021. So you haven't seen the whole year yet of the December 31st, 2021. Bottom line is we will only include 2020 in this answer. All right, so I go back. I begin. I'm looking at 2020 only, and I am going to include the 20,000. So I'm going to add that 20,000. Okay, that would be a debit to my investment account. Look at the journal entries, but what the parent would do is they would debit the investment account and they would credit a revenue account, all right? But look at those journal entries. Debit 20,000. All right, now I look at Ramby's dividends. Now I'm going to include those dividends. Remember, when it's the equity method, the dividends will subtract from the investment account. So I credit the dividends. Then, when it's the equity method only, I will include the amortization for 2020 only. Amortization will credit the investment account. Actually, just so you know, it ultimately ends up reducing the net income, all right? But sometimes it's easier for students to see it like this. If you wanted, you could take the 20 minus the 12, whatever way. All right, but the final balance is 577,000. So when it's the equity method, your answer is 577,000. All right, now let's do it when it's the partial equity. Well, the partial equity is very similar to the equity, okay? Except it's not going to take into account amortization. All right, so we go over here. I'm just going to start with 574,000. I can just recopy, right? I will add in the 20. I will subtract out dividends only, and then I'm done. No amortization. So my answer to the partial equity is 589,000. Okay, the last method is the initial value method. This is also known as the cost method, everybody. The initial value method. This is the easiest. Simple, simple. All it's going to take into account is, for the investment account, is the 574,000. That's it. So for the investment account, your answer will be 574,000. So sometimes students say, Professor Clay, I thought with the initial value method that dividends do affect the parent's income statement. And I say, yeah, you're correct. But what would you do? All right? You would debit either for dividends cash or dividends receivable and credit dividend revenue. That doesn't touch the investment account, and that's the question that it's asking. If it's asking for the income statement, our answer would have been different. All right, so that's how you do B. I'm going to erase because I'm running out of room, all right? However, everybody keep notes on these. We're going to want to go back to these. All right? So I'm going to erase. Okay, so what's C asking? Here's C. And let me get the exact question, because rightfully so, when you're first learning this, it can get confusing. Under each of the following situations, what is entry C on a 2021 consolidated balance sheet? All right, so worksheet. Bottom line is, now it is consolidated. All right? This question, the one I just erased, was not consolidated. Entry C is going to affect your beginning retained earnings balance only. Okay, so entry C is going to affect your beginning retained earnings balance only. So, under each of the following methods, the parent uses the equity method. Well, here's the good news. If the parent uses the equity method, they're all set. No entry is needed to convert these past figures to the equity method. They have already been done. The equity method, just so you know, is the most difficult. The initial value method is the easiest, and partial is easier than the equity. All right, so equity, your answer is no entry is needed. Let's go to the partial equity. Okay, now, here's what I want you to get. It's asking for beginning retained earnings, which is under C, and for the 2021, so that's the beginning, it would only include 2020. It will not include 2021 because it's the beginning retained earnings balance. So, what is needed if it's the partial equity? If it's the partial equity, what have you not done yet? Well, you have not adjusted for the amortization. So what you will do is you'll debit retained earnings, $12,000. Remember, that's going to reduce retained earnings. Amortization is an expense. And then you'll credit the investment account, $12,000. Okay, so that's reducing the investment account as well. And that will finally recognize amortization. That's the partial. When it's the initial value method, all right, you've got a lot of adjustments with this one. This is why now it's consolidated. When it's consolidated, now you have to take into account net income. They didn't take into account net income. But let me kind of write this for you. So they didn't take into account net income. But they did adjust for dividends. So dividends, net income was $20,000 for 2020. They adjusted for dividends of $5,000, right? Oh, yes. So you still need to adjust for $15,000 for the net income, okay? You also need to adjust for the amortization. What will amortization do to net income? It will reduce it. So we're going to subtract 12,000. So the adjustment for the initial value method will be $3,000. Let me show you what the journal entry would be. Okay, so that's 3,000. Just so you know, that's a positive, right? That's a positive. Let me go back. You didn't adjust for net income. That's positive 20. You did adjust for dividends. That brings it down to 15,000. That's still a positive. You didn't adjust for amortization. That's 12. So it's a positive 3,000. It's going to be a different entry than this because this one was negative. This is positive. So I debit investment in Ramby's, 3,000, and I credit retained earnings. And the date for retained earnings is 1/21. I'm sorry, 1/1/21. Okay, so 1/1/21, and that is a $3,000 that we're going to credit retained earnings. Okay, I know that's a lot in that problem. That's why I prepared you that it's tough. Please maybe watch it more than once so you get this. Read the book. What's the difference between consolidated information and before you consolidate? Okay, so this question was asking for consolidated beginning retained earnings. That was question C. Question B is before you consolidate. Question A is after you consolidate. So go through this again and practice that, and I will see you soon.